Welcome. Thank you for joining today. And a lot of you are concerned out there, and I've gotten a lot of questions and requests last week. So I figure I'd just do one call for everyone to answer a lot of questions. And so I just want to introduce myself a little bit. My name is Joseph Zhang. I've been trading and learning about Wall Street and investing since I was 13 years old. So I started trading when I was 16 and been on Wall Street ever since I graduated. I've worked at the big banks for 10 years plus, at Credit Suisse, Deutsche Bank, where I headed up coverage for hedge funds. And so there, I actually covered some of the largest hedge funds in the world. And then I co-founded a hedge fund in 2005 and a brokerage in 2008 in the middle of the financial crisis. So there's been there's been five stock market crashes since in the last 20 plus years. And I've lived through all of these. And this is how my career kind of took off. So in 1996, right before the Asia crisis, I joined Credit Suisse and started trading Asian equities at Credit Suisse. I moved to Hong Kong right in the middle of the Asian financial crisis, towards the tail end, and started working with UBS in 2000, right before the tech crash. So it was quite the experience trading the tech crash, and I went through the SARS crash in Hong Kong, which was more of a local thing, but it was extremely scary and reminds me a lot of today, actually, of what's going on. And then I started a brokerage in 2008 in the middle of the financial crisis with some partners, and that was an equally scary thing. And what I really learned after all of these crashes is that if you start something during these things, it's probably one of the best opportunities that you can have in your lifetime to do these things. So in the words of Albert Einstein, in the midst of every crisis lies opportunity. And every one of those times I actually took the opportunity to do something more, entrepreneurial every single time, and it's always worked out. But during that whole experience, it was extremely scary, just like it is today. I mean, this has been the biggest crash that we've ever seen in our lifetimes. I've never seen something crash so fast ever. And in fact, this is the fastest crash ever in history of the markets. And so it's been quite scary. But I think we're going to put some perspective to it. So right now, last year, just in my own portfolio, I trade for myself. I manage some private accounts. In my own portfolio, I was up 45% last year. I'm up high single digits this year. I don't want to jinx it, so hopefully we stay that way and continue. But it's going to be a very rough ride. And this picture is a picture of myself and my new partners. We're actually starting up a new fund just as we speak right now, focusing on algorithmic trading and automated trading. So that's something that we can go through later on as well. So really take this time. I think I just want to give some perspective, first of all, before we go into the markets and how scary it is and everything else. Because look, everybody's already scared. Everybody's already been through a lot. So I just wanted to kind of remind everybody to enjoy the little things. For one day you may look back and realize that they were actually the big things. And, I've had this chance, I used to travel a lot. I used to work all the time. I'm a workaholic. I travel all over the place. I didn't spend enough time at home, and I actually am really, really grateful that I have this time to stay at home and to trade, to cook. I love cooking. I've cooked the Peking duck and all kinds of crazy things. Um, I got to spend some precious moments with my family, my daughter, my son. Uh, you know, my daughter just turned 16. It's an incredible time. My son is actually homeschool. I'm homeschooling my son right now, and I'm teaching him all kinds of things, including uh, trading the markets. I'm teaching him charts, candlestick charts. During this time, I've been able to really do a lot of the things that I've always wanted to do, including start a podcast and do all kinds of things with the family, and even teach my dog how to trade. So, um, so this is it's been a really precious time for me, and despite everything that's going on, I think we can also, before going into this crisis, there was all kinds of trade wars going on, global warming. There's all kinds of authoritarian rule. Everything was going wrong. Fake news, Wall Street. Walls were being built. Hatred all over the place. I think this Bill Gates actually just sent out a note saying that this could be the great corrector, right? So basically reminding all of us that we're all equal. This virus doesn't care what color we are, what age, what um, where we're from, what country. It knocks down all kinds of walls. It tells us that we must work together, and that globalization is actually a very natural part of our human evolution, and isolation is definitely not. And that health and family and happiness is probably uh, is part of the wealth that we enjoy, and not just monetary, right? And that time is the most precious of all, right? And the time that we spend with our families, the time that we have to do the things that are purposeful for us is extremely important. So I think it also, this gave Mother Nature a chance to breathe, right? I mean, it finally knocked some of the pollution out of the air, and so this is going to pass, and this is actually the beginning of something better, I think. So let's get into the coronavirus. I don't think I'm not gonna put too many charts or anything like that. This is the only chart I'm gonna show of the coronavirus. It just shows that the U.S. is in a very early stage. We're gonna have at least another month or two of rising numbers before any possibility of even flattening the curve. And I think at the moment, the US isn't doing enough to flatten the curve right now. So let's hope that in the next 2 weeks or in the next week that they actually really clamp down. Um, they're going to have to do some extreme things in order to flatten the curve. And at the moment, it's not looking that way. So it's looking like it's going the same trajectory as Iran and Italy, and now Spain is going the same way. So it's not looking good for the next month. Now, one of the main things that I wanted to share with people is that I almost read or watch no mainstream media. And that's really, really helped me a lot, because, unless you want to follow everyone, you probably shouldn't be, watching mainstream media. If you want to follow what everybody else is doing, when they're all rushing to the supermarkets and crowding everybody, and when they're all selling stock, you're selling at the same time. That's probably the worst thing that you can possibly do. So almost everything that I do right now is not from mainstream media. Okay, so here are some of the sites that I wanted to share with you just on the coronavirus. Okay, so for the coronavirus, there's some very, very good channels to follow. Some are on Twitter, and some, there's a LinkedIn for Raul Pal, and he puts out a daily update, which is excellent. There's a YouTube channel called Peak Prosperity, which is one of the best updates out there. They're giving an update every single day. It's very thorough, and they do an excellent job. The University of Washington, where all of this started in the U.S., they're doing an excellent job with everything. And then Remy is also putting out a lot of great charts on Twitter as well. So all of these are great sources, and I go directly to these sources to find out what's going on. I don't look at mainstream media. I try to really block that out as much as possible, and that's actually helped me a lot through this whole process. The other thing is that there's, Twitter has been an amazing tool, and part of the reason is because, what I used to do is, I used to pay $3,000 a month for Bloomberg, and for the last 10 years, that was probably the best possible, news that you can get from all the insiders, from all the smart people, all the big hedge fund managers and everything. That's the place that they were all exchanging info. Now it's gone all on Twitter. It's so open now. It's unbelievable. So and I go back to some of the smartest guys that I know during the times that I was covering them at their hedge funds. Some of the guys that made the most money, those are the guys that I follow now. So Raul Pal used to be at Goldman Sachs. He ran the hedge fund desk at Goldman Sachs. He was the emerging markets macro fund manager at GLG, which was the biggest hedge fund in the world back then. And he was one of the most successful and made the most money in that firm. So I've followed him since, early on in my career. And he now has Real Vision, which I think is a great source. So if you go to Real Vision, you can subscribe for $180 a year, which is extremely cheap for the stuff that you're getting from him. There's a couple of other ones, Mark Yusko for a kind of a new view from in terms of. So I'm gonna. Yeah. So Mark Yusko, he has a lot of information on a lot of the new stuff, and so a lot of the cryptocurrencies he's looking at, a lot of the just kind of getting some new perspectives, right? Not just looking at all the old perspectives. Shivaco Capital is actually quite a good resource. George Gammon is one of the best economics and financial professors out there. Just watching his stuff, it beats any classroom in terms of learning about what's actually going on in the financial world, in terms of the Fed, in terms of what the interest rate policy, the Fed, all of the stuff that they're doing right now, they're making it up as we go. None of the stuff I learned in college. I mean, everything that I learned in college in terms of economics has been thrown out the window. Everything that they're doing right now they're making it up as they go. So George is a really good guy to actually go through and actually figure out what do those things actually mean? What are they actually doing? So for the young listeners out there, it's probably a great source to just figure out some of the stuff. And surprisingly, there's a app called Discord. It originated as a gaming app, like a gaming chat app, but all the financial people are not actually getting on there right now. So there's some great channels on Discord to go on as well, and I'll include some of those channels later on in my updates to you guys. So if you guys signed in on the forums, I'll be able to send you some of the stuff. So let's get into the markets really quick. Overall, the equity markets are down between 30 to 40% across the board. And the best performing assets right now are the U.S. dollar. Okay, the U.S. dollar is up 4%. Okay, the U.S. dollar is up 4%. U.S. bonds are up right now 8% since the peak in February 19th, but it's been a very wild ride. In fact, it was down 23% from the highs, all within a week. So it's been a very wild ride there because of some hedge fund liquidations going on there. Gold is down 9%, even though we all think that gold should be going up in this environment. But, because some funds have been liquidated, there's gold volatility is up a lot. So there's been a lot of liquidations and people holding gold as well. So I think gold has actually broken down the uptrend. And I think, if you look back at 2008, gold was actually an underperformer, really. I mean, it was down quite a bit. Even though it outperformed the equity markets, it was still down quite a bit. So it wasn't that great of a holding. Hong Kong is down 24%. It's actually relatively better off because Hong Kong has been, we've gone through the SARS epidemic, and people here are generally more prepared. They're very good about quarantines, and the hospital system is fantastic with a very good public hospital system here. So so we're very fortunate to be in Hong Kong. The U.S. emerging markets are all down 30+%. Silver is down 30+%. So silver is not a good holding at this, in this type of deflationary environment. Bitcoin is down 40% from the peak, from February 19th peak, but it's only down 13% year to date. So, Bitcoin is hanging in there, and, it's still a kind of an outside play in terms of if you believe that the central banks are printing unlimited number of dollars and unlimited amount of currencies, then Bitcoin is an outside play. So have a very, very, I always suggest having a very small part, like a 1% part of your portfolio in Bitcoin, especially with the halving coming. We could talk about that more, but home builders down 50% despite interest rates being, the lowest ever. You guys should probably think about remortgaging your home, refinancing your home, because the mortgage rates have actually been going up despite the interest rates coming down. And that's because of some technical reasons. But home builders are down a lot. Gold miners, you would think a lot of people hold gold miners, for their exposure to gold, and gold miners should actually be making money right now because their cost is about 11 to 1200 or less than 1100, I think. So they're actually making money, but gold miners have been really hurt by just liquidations. Okay. And crude oil, there's, obviously I think you guys all know what's going on in crude oil. There's a global war on trade war on oil and energy stocks. So that's the worst performing right now. So that's where we stand right now. I just wanted to kind of go through that first. And right now, cash is still king. You know, with the dollar still rallying, I think the dollar um, may have actually broken out to the upside. So you know, watch out if you're holding a lot of other currencies other than dollar. You know, it looks to me that with this crisis continuing, the demand for dollars around the world, there's a very short supply around the world of dollars right now. And so, you know, the dollar could continue to trade higher. There is a ETF for dollars. It's called UUP. So, you know, that might even be safer than US bonds, for instance. Although at this point, the bonds have corrected quite a bit. And, you know, the US bonds in terms of like TLT, some of the short SHY, all of these bonds could be a good, you know, a good, good to look at right now, just because, you know, it's corrected quite a bit from the highs in the last 10 days. So one of the things that we're looking at is credit spreads. So the high yield corporate bonds in the US have been just absolutely obliterated. And the credit spreads have widened to around the 9 level. And if you're looking at the similar levels in 2000 and 2008, after those dates, the equity markets continued to fall another 40% after that. So, and they continued to fall anywhere from 6 to 18 months after that before it made a low. So credit spreads are just blowing out. There's so many companies that are going to go out of business despite everything that the Fed is doing. It doesn't matter if you know, it doesn't matter what rates the interest rates are, because nobody can go out. If nobody can go out, they can't spend. And so businesses will go out of business. You know, a lot of businesses will declare bankruptcy. And so the credit spreads are going to continue to widen, and that's going to affect the equity markets. Like I said, if we're just looking at 2008 and 2000, both of those times when the credit spreads reached this level, the stock markets continued to fall another 40% after that. So that's really important to understand. In the US, the numbers are just starting to come out. This Thursday, you're going to see a massive jobless claims number. In fact, the White House has actually, you know, postponed this number. Okay, I don't know for what reason they would postpone it. I mean, it's going to happen regardless whether they postpone it or not. So, the Fed, one of the Fed chairman, one of the Fed officers, Bullard, actually said jobless rates may soar to 30%. I mean, I don't think they're going to soar to 30%, but if it soars to 30%, it's basically 1929 level. You know, then you can't even look at how 2000 and 2008 traded. You have to look at how 1929 traded, which is, you know, basically really bad. Okay, so I don't know how else to put it. Everything is on the table. The Fed has been, you know, pumping money, trillions of dollars into the market, and most you know, part of the reason they're pumping in trillions of dollars is because some of the energy companies are going bankrupt. Okay, and some of the hedge funds have really just blown up as well. So over the last week, there's been some major blowups that we haven't heard of in the mainstream media because they're trying to just cover that up. They're trying to not talk about it so that it doesn't create mass panic. But there has been some hedge funds that have had to liquidate their portfolios. There has been, energy companies that are completely, I mean, they're bankrupt basically. So the high yield, most of the high yield out there is from the energy companies. So that whole segment is going to really um, be hurt by this whole thing. And so there is some kind of bailout for that right now. And I have my opinions on the bailout, and we can talk about that later as well. But here are some other signs that's absolutely unprecedented is the manufacturing numbers out of China, the auto sales numbers out of China. It's dropped 80 to 90%. This has never, ever happened, ever. The same thing's going to happen in the US. The same thing's happening in Europe. This has never happened. I mean, not even anything close. So when people ask me, do you think this is going to be a similar drop to 2000 or 2008, or actually most people are actually still looking at the 2018 low, which was basically last week's low. So we closed near the 2018 low last week, and people are still asking me, do you think it's going to go through those lows? And I said, well, last Christmas, did you, or two, was it not this past Christmas, but the Christmas before that, was the whole world shut? And did you feel like you were going to lose your job? And, were Chinese auto sales and auto sales around the world, and was the whole economy around the world stopped? And the answer is no. So we're going to blow through those lows and in 2018. That is for certain. Okay. That is for sure. That's like 100%. But are we going to stop, near the 2008 lows and are, in terms of magnitude? I don't mean levels, I mean magnitude. So both 2000 and 2008 had around a 50% retracement. So an equivalent of a 50% retracement from the highs is about 1700 to 1750 on the S&P 500. I think Friday we closed at just below 2300, and we're actually trading down another 5% in pre-market right now. So we were limit down earlier this morning. We've come off limit down. We're down like 4% right now, probably. So at the let's see what the next chart is. So just looking at this is the past recessions. Just looking at this, this definitely looks more like 2008 and beyond. So it definitely does not look like any of these smaller contractions, which is like between 1% and 3%. So this definitely looks larger, or equal to or larger than 2008. I don't think we're gonna get quite to the level of 1929. Let's hope not. But this is a good reference point, right? So if you want this reference, at least how long it's going to last, and so we should, at least be about a year out before we, hit the lows. So here's the Wall Street psychology of the market cycle. Where do I think, this is just my own opinion, where do I think we are right now? We're pretty much right between just past denial, between just above panic level. Okay. Because a lot of people still have not sold. They have not panicked out of the market yet. Okay. They have not sold. A lot of them are asking whether they should sell, but they have not sold. Okay. So right now we're still kind of in the denial phase. We're not in the panic phase. The panic phase can take us anywhere from 10 to 30 to 40% lower from here. Okay. So, and what does that depend on? And I'll go through some metrics to see how we can judge, what's the magnitude that it will be, right? So just looking at this chart of this is a
这个
very
还真
long
是
term.
还蛮不错的了。
Yeah, this is a very long term monthly chart of the S&P, and on the monthly chart we are definitely not oversold yet. Okay, we've only got, and we haven't even entered the 30 level yet. Okay, so in the in all of the past bottoms, not only have we entered we don't buy it on the entrance of 30, like when it hits 30. You buy it when it comes out of 30, right? So it hits 30, goes below 30, and then comes above 30. Then you start to look at, okay, which stocks do I buy? Don't buy it when it starts when it first hits 30. Do not buy it then. Okay, so we haven't even hit that 30 yet, and I think we're going to hit that in the next month or two. Whenever that's going to be, 2 months, maybe 3 months. And then we have to wait for it to come above that 30 level before we even consider buying. So there's, just in the last week, there's been some bailouts already, and that's what's caused the massive, like 20%, volatility within 1 week of, treasuries bonds. I mean, for God's sakes, treasury bonds are, 20% in a week is just absolutely crazy. US dollar, 10% range in a week. Absolutely crazy. It's never been seen before. I haven't even seen it after four four major crashes. But one thing to kind of note is that all the money that they're printing through QE and through bailouts is basically is really bailing out the hedge funds, bailing out the big corporates, and the money, a lot of the money never flows down. So the Fed policy for the last X amount of years has always been, let the money flow down, right, to the commoners, but to everybody else. But the money never really flows down, and that's a huge problem. So the other thing is that there's been a lot of talk about just giving money in terms of in the form of UBI, Universal Basic Income, and I think that is really the equivalent of QE, but really instead of trickling down, it actually goes directly to the benefit of the ones that need it the most. So even though there's a lot of controversy over this, I actually think that UBI is just the same equivalent of QE, but for for the needy. So okay, and so what are we going to look for in order to find a bottom? Okay, so in order to find a bottom, first we need to see that the US is decelerating in terms of new cases. Right now, the new cases is still accelerating. Okay, as long as the curve continues to go in the same trajectory, the markets are not going to bottom. Okay, secondly, China has gone back to work. Okay, there is a risk that there is a second wave of infections coming. If the second wave comes, the only way that we're going to really find out, because they're probably is through the economic activity. Are the planes actually flying with a lot of people on there? Are the car sales going back up? Is the electricity use back up? Is the pollution level back up? There's actually a site where you can look at the pollution live in China to see if the pollution is building up. That means the economic activity is going again. So that's one of the things that you can look at. And then obviously peak prosperity, you could go there to see if this whole thing is kind of leveling out in the US. So here's the channel, the ESA Earth Observation Channel. You can go on there and actually observe live what the levels of pollution is in China. If the pollution is getting bigger, that means all the economic activity is getting back again. Also, the bookings on Open Table, all the restaurant bookings. If the U.S. restaurant bookings are starting to turn around, they're starting to go up again. Right now, it's down 100%. Right, 98% is down. So, if it's starting to pick back up again, that's a good sign that that we're starting to bottom, and then you can start to bottom fish some stocks again. So I don't know when the markets are going to stop, but here's my roadmap. Okay, and the important thing is really to have a roadmap, and the roadmap is really to have the best case scenario, the base case scenario, and the worst case scenario. Okay. The best case scenario is that the markets bounce off of this 2100 level, which is kind of where we are right now. And that's the only way we're going to get that is if the curve starts to flatten like very, very soon. The bazooka comes, all this money printing, and and the summer is getting warmer, and that really slows things down. Either way, we're not just going to bottom once. We're going to retest the bottom either way. So even if the market spikes up to 2600, we're still going to see a retest of this. Now, this is the best case scenario. This is not the most probable by far. I don't think this is very probable at all. But let's just put that there just in case all of these things happen. There is, let's just say the vaccine comes. The summer really slows the contagion. The Fed's bazooka is taking effect. So all of those things have to happen in order for the markets to kind of hold this 2000 to 2100 level. Okay. And the bounce will be quite big. I mean, the bounce could be 25 to 30% bounce. All bear market bounces are 25, 30% of magnitude. Try to, if you haven't sold, sell at that, into that bounce. If you haven't sold some of the stocks, right, sell into that bounce. Don't don't pick the absolute low to sell right now. But the base case scenario is some of the things that I listed. Is the US kind of is still slow in quarantine and everything else. They kind of they're not doing a great job, and people don't really take it seriously. The markets can go down to, somewhere 1700, which is the 50%, fall from the highs. Okay. After it hits around 17 to 1800, I am expecting a bounce, not to the 2680 level, but probably to the 2380 to 2460 level on the S&P, okay? And then you're going to see another, everything that I see in front of me does not suggest a V-shaped recovery, okay? Unless scenario one and the vaccine comes next week, in which case, all bets are off, the markets are off running again. But look, there's been a vaccine for the common flu for forever, and half of the population still don't take it. So it's not like just because there's a vaccine and it becomes available to the millions of people around the world, which that's another thing, is like, even if a vaccine comes, it takes a long time to implement. Okay. So that's kind of the base case scenario. The worst case scenario is that we hit a second wave. The summer doesn't stop the transmission, and we go that, if that's the case, China has a second wave, reignites with more cases, a reacceleration, in which case we go into 1929 mode, and that's really, really bad. Okay, so that's the worst case scenario, and that means that we, the next level after 1750 is 1350 on the S&P 500, which is unthinkable. Okay, but that is the worst case scenario if those things happen. Okay, so this is a better way of looking at the markets than to actually just try to pick a number out of the hat or something like that. You have to look at the scenarios. Nobody knows what's going to happen, but when it happens, at least you have a roadmap to see where you're going. Okay. So right now we're still in a defensive mode period where we're still in a deflationary state of the economy, part of the cycle. So right now it's very defensive, and I would look at any 20% bounces to sell the stuff that you haven't sold on the bottom. Do not hold these in this environment, right? If you have any of these types of stocks like tech stocks, energy stocks, momentum, high beta, industrials, junk bonds, all of these things, sell it into the rally, sell it into the bounce. If there is a bounce coming, and there's always a bounce coming, every bear market gives you a few bounces to sell into. Okay. If you're nervous about selling it all, sell half. That's what I always do. If I question myself, like, do I really want to sell? I sometimes I don't want to sell it all, and I just sell half at least, right? And at least you have a better place to make decisions. Okay. So so that's it right now. I can answer some questions. I know this is kind of going pretty fast because like the Zoom keeps on going out anyways. But I just wanted to give you guys kind of a roadmap, at least to figure things out, and understand, like, if these things happen, then what is the roadmap to how things will go going forward. What to invest in is less important than when. Okay. And when is really looking at this scenario analysis, right? Looking at this right now. And I think that's the most, looking at this. This is a really important, thing to keep in mind. Okay. If, we want to sell bounces, a bear market has never ended without a bounce and then a retest of old lows. Okay. So this is, it's never happened. Okay. So, so this market is not going to go straight down 30% and then straight back up to new highs. It's not going to happen. Okay. And so, or at least, unless the best case scenario happens, which is still a very, very long shot. Okay. So I think that's the most important thing. And so if you know that, then if there is always 30%, 20, 30, 40% bounces during a bear market, I think I'm still on, right?
Yep.
Yes.
Okay, cool. So yeah. And then, and then once you get yourself positioned, maybe sell half into that bounce. If you have some of those types of high, like technology, economically sensitive stocks, industrials, junk bonds, any of those types of things, sell into the bounce, right? At least sell half. You don't have to sell it all, right? But sell half to get yourself into position to buy it when the market bottoms. Okay. Otherwise, if you don't sell any, you don't have anything left to buy. You don't have any ammunition to buy during, when it finally does bottom. Okay. Secondly, I think, let's see some of the other questions. I actually think that one of the most hated markets right now, around the world is the China market. Okay. Everybody hates the China market. Nobody owns the China market. The MSCI, in the global weightings for China market is about to go up in the next few years. It's going to go up steadily in every single pension fund. So I actually think this is not at all, this is not at all other people's thinking. This is a very, I actually think the China market will outperform in the next 18 months at least. So, looking at the China markets might not be a bad thing. But we have to kind of wait for a few weeks because we want to see that there is no second wave going on in China. If there is a second wave, then the markets are going a lot lower in China as well. Okay. So finding the bottom, I think we kind of went through some of those scenarios in terms of, you know, I think 2008 is the best case scenario that we're down like, so, you know, that's the base case scenario where we're down 50% from the highs. So I think, you know, around the 1850 level, right around that level is 50%. So, you know, that's when things get interesting for me again on the long side. Until then, I'm selling every you know, every rally I'm going to sell into and try to reshort. Yeah. Do you think it's going to be V-shaped or U-shaped? You know, I myself don't think that the best case scenario is going to happen. So therefore, I don't think that a V-shaped is possible. I think it's going to be more U-shaped. But that said, because we dropped 4 times faster than every other bear market, we can also, you know, when the U starts to kind of come out of the U, when we start to get some real good bottoms, we could come out of that really quickly, meaning we could go from a bear market and come out of that very quickly, you know. So even though it's a U, you know, because it'll kind of bounce around down here for a while because it, you know, I think the Fed was just saying the quarantine is going to be at least 10 to 12 weeks. That's a long time. Okay, that's a long time. So if it's going to be well into this summer, then there's no economic activity. The market's not going to be able to bounce off of that. So until we see the curve come down, then we're going to be able to, you know, until we see the new cases curve kind of flatten a little bit. That's first sign. Second sign is, you know, looking at the market's trying to bottom as well, right? You don't have to pick the low. You don't have to catch the falling knife, right? So let's see. Okay. Would you take all of your money out of equity markets? What's your gut reaction? You know, I mean, just, I can only tell you what I'm doing. What I've done is I've taken out almost all of my long positions, and I'm using kind of bounces to short into right now. That's what I'm doing. But that's not what everybody should be doing, because, you know, if you're you know, if you're not trading the markets, you should not be doing that. You know, selling half is always you know, a good way to at least get some money so that you have some ammunition for when the market bottoms. Okay. And also just look at, you know, most people don't even know what they own. They own a bunch of funds and they don't really understand what they own. So you have to really look at your portfolio to see that you own more, you know, of the defensives, and the, you know, you should have 30 to 50% in bonds right now. I think interest rates can go negative, which means if interest rates go negative, bonds continue to go higher. Okay. So even though bonds have had a very nice run up already, they've corrected 20% from their highs, and it might not be a bad idea to, you know, still buy some bonds here. So dollar bonds, I probably would avoid gold right now and silver. And, you know, dollar and bonds, I think those are the way to go. And just some, you know, high, you know, some, I don't know, some real blue chip consumer staples, you know. So I won't go into specific names, but you know, some really good consumer staples type of stocks that you know, companies that you need to use whether it's a recession or not, right? And what's the effect on currencies and oil? So oil is still an avoid at all costs. Still, I would not go and try to bottom pick oil at this point. In fact, the oil stocks, there's a lot of them that are in trouble. So don't buy the oil ETFs either, because a lot of these companies may go out of business. One of the things that I keep on hearing people tell me is that, hey, this isn't 2008 because the banks are fine. They're recapitalized. Yes, every single crash has a different sector that goes belly up, right? So for 2000, it was a whole tech sector that went belly up. The last, 2008 was the whole banking sector. This one is not going to be the banking sector. It's probably going to be the energy sector and other sectors that are going belly up. So yes, the banks are better, well equipped this time, but you have to remember, it's every single crash is a different sector that goes belly up. Okay. Secondly, one of the main things to realize is that, I know that a lot of people, blame China for this crisis, and they have to take the blame for it because it did start in over there. But the thing is, the last crisis in 2008 was entirely started by the Americans, and all the over leverage and all the bad lending practices, all the things that was happening over there, and that basically pummeled the whole world economy as well. So everybody has to take the blame at some point. We this time, yes, it happened, it started in China, but everybody has to deal with it now. There's no point in blaming people. Just deal with it, right? Just figure out a way to deal with it. Never mind blaming people. You could have blamed the Americans in 2008, but what's the use of blaming people? You just have to deal with it, right? So that's one that's another thing that that was one of the other questions. Anything else that anybody wanted to share with us or comment on, or anything else?
Joe, did you see the question on the corporate bond funds?
On the corporate bond funds?
I sent it just a second ago.
Oh no, I must have missed that. Why don't you? Yeah, what is the question?
Just your thoughts on high grade corporate bond funds right now, and where you think they might bottom. Yeah, or also any indicators of when to identify the bottom.
Yes. So the corporate, the credit spreads, the credit spreads is something that you definitely need to look at. It's the corporate credit spreads. I showed one chart on that, and that's just starting to enter the danger zone, which means we're not even at the high of it yet. We just started entering the danger zone. So any corporate bonds, whether it's AAA or whether it's junk, obviously don't own any junk. And if you own junk, you got to sell it, or you have to hedge against it with the ETFs and stuff like that. There's high yield ETFs that you can hedge, use to hedge. But I don't think we're at the end of it. We're at the beginning of it. Okay. And I think that would cause a lot of liquidations because of the ETF crisis that we're having. I think Mike Burry actually called the last crisis, mortgage crisis, and now he's calling this crisis as well, because he actually came out, 6 months ago and said there's a massive ETF crisis that's going on right now, and it's basically unfolding right in front of our eyes. So yeah, I think we're very early in the credit cycle, in the bankruptcy cycle for corporates right now. The corporates got way too cheap capital for way too long, and they over levered, and so the biggest bubble this time around is not the mortgages that caused the banks to go bankrupt. It's the corporate bond market. That's really the corporate bond market, led by the energy sector. Anyone else have some questions that I haven't answered yet? Okay. Any other questions, guys?
So Joe,
Yeah.
quick question. I saw your charts about, the time frame between each recession, how long it's gonna last. From your best guess, how long do you think it will take to kind of plateau, bottom out, and start picking up? Do you think, is it like
Yeah.
a 3 to 5 year, or is this like a 1 to 2 year? Or
So, again, it depends on the scenario, the worst case, base case, and best case scenarios, right? So, let's just talk base case scenario, right? Base case scenario is that the U.S. bottoms in terms of the cases. The U.S. starts to flatten in 2 months' time, right? And that's kind of the base case scenario. If that happens, then I think we can bottom within a year, right? Right now, it's only been a month. Do you know that it was exactly 1 month ago that we were at all-time highs? So, anytime that it's fallen this fast, it doesn't recover right away. And in fact, we have to wait for the U.S. numbers to kind of to flatten out first, and we have to see some economic activity coming back as well around the world. We have to see that Spain and Italy are starting to come out of their, catastrophes going on right now. That in Spain and Italy. Things are at the catastrophic level there right now, and the U.S. may enter that level in a month's time. If we enter that level in a month's time, the market will be quite a bit lower than it is right now. So my base case is like 9 months from now is like the best case scenario. And where it bottoms, say 8 to 9 months from now. That's if they come out with some kind of vaccine. They come out, the infections start to slow, economic activity starts to pick up again. Then the markets can bottom anywhere from 6 to 9 months from now. That's the best case scenario. If it's kind of base case scenario, we're talking about anywhere from 9 months to 12, 15 months. And if it's really bad, if it accelerates and gets worse, then we're talking about anywhere from 18 months to 3 years before it bottoms. And this is not uncommon. If you look at 2008 and past bear markets, it's taken 2 to 3 years before. That's not uncommon at all. And I think I showed this chart as well. Hold on one sec. Let's see. Yeah. So this chart shows the credit spreads, which corporate bonds are defaulting and stuff like that. When the credit spreads gets to this level in 2008 and in 2000 and in the year 2000, it took another 6 to 18 months and another 40% down in the market from that date. Not 40% from the high, 40% from that date means 40% from Friday's close. 40% from Friday's close is near 1,300 on the S&P, which is very, very low. Like, it's almost unthinkable. Okay. I don't think we're going to get to that level because the Fed is really, really just pumping everything they have right now. So I really don't think that we're going to get to the worst case scenario. That's why my base case scenario is somewhere near 17 to 1800 level on the S&P. Okay. And the best case scenario is we stop somewhere around the 2050 to 2150 level, which is where we are already. Like this morning, we hit 2169 this morning on the S&P futures. So, we're basically there already. So I can't imagine that would be the low. I just can't see it, especially given that the curve suggests hundreds of thousands of new cases in the U.S. in the coming month. I can't see the markets bottoming in the face of that. Okay. So that's why I don't think that that's, that best case scenario is going to happen. I think it's more likely the base case will happen. And then if it accelerates, then we're really in trouble. And we're going down over 50%, which means 60 to 70%. And most people that I talk to still have not sold, because it's not because they didn't want to, it's because it's fallen way too fast. This is the fastest it's fallen. It's literally fallen off a cliff. Every single bear market has basically given you, 2, 3 months, 4 months to sell. This one, it's given you no time. This one's 1 month straight down. It's never been seen before. Okay, anything else? Any other questions? Here's my contact details. Also, the podcast that I just launched, it's worth a listen as well. If you have any questions, you want to contact me on either Facebook Messenger or on email, and most of you have my WhatsApp already. Anyway, so yeah, definitely get in contact with me, and I can answer some more questions.